All right, for this video, I wanted to talk with you about the U.S. tax issues for B-2 visa holders that enter the United States. So, what is a B-2 visa? The B-2 visa is issued to citizens of non-U.S. countries who wish to enter the U.S. temporarily for purposes of tourism, right? Or if they want to enter for a medical procedure, right, that they otherwise can't obtain in a different country. And the B1 visa, they kind of go hand in hand a lot of times because you can apply for them simultaneously. But the B1 visa is issued to somebody that wants to enter for business purposes, okay? Now, what are the U.S. tax issues for B2 visa holders? Well, generally speaking, so the B2 does not make you a U.S. tax resident, right? Which is significant because you don't want to become a U.S. tax resident, meaning you don't have to file tax returns in the U.S. and report all of your income from worldwide sources, right? That's 100% what you want to avoid. The only types of U.S. tax residents are U.S. citizens, U.S. green card holders, or those individuals that are physically in the United States enough days to meet that substantial presence test. Now, what we're going to talk about is how B2 visa holders could become a U.S. tax resident if they trip over that substantial presence test rule. So, so back to the immediate U.S. tax issues. So, B2 visa holder enters the U.S. for tourism. Generally, no U.S. tax issues, but if you enter the U.S. for tourism purposes and you do end up working and earning a wage, then you might be subject to U.S. taxes. And the reason for this is because anytime you are physically in the United States and you are working and earning compensation, wages, whether that's from a U.S. company or even a foreign company paying you while you're physically in the United States, that constitutes being engaged in U.S. trade or business. And when you're engaged in U.S. trade or business and you have that earned U.S. source income, you've got to file a tax return and pay taxes. Now, the visa issue broadly here is, well, you shouldn't be earning any income anyway because your visa is limited to just tourism, right? So B2 visa holders are not supposed to be earning money while in the U.S. because it violates the term of your visa, right? So there's Department of Labor regulations here that you need to be mindful of, and then also just the tax problems. So don't be, if you're in solely on a B2 visa, don't be earning any money, right? Because that violates the term of your visa and you might have to file a tax return and pay taxes. What we want to avoid. Now, back to the substantial presence test issue. A B2 visa holder, if they are physically present in the United States enough days to meet that substantial presence test, then they could become a U.S. tax resident. U.S. tax resident means you file a Form 1040. It means you have to report all of your income, no matter where it comes from. That's including investment income. And then you have additional disclosures like filing FBARs, 8938 for disclosing foreign financial assets. If you own stock in foreign companies, maybe you have to disclose it. Maybe it's a PFIC, so you got 8621s, control foreign corps, 5471s. The list goes on and on. So certainly something you want to avoid is becoming a U.S. tax resident. Now, what about treaty relief? Well, B2 visa holders, well, again, this is a violation of your visa, but just as an aside here, if you're an entertainer or an athlete, let's say in Canada, and you come to the U.S. on one of those B1, B2 visas, then you can exempt from income 15K from your U.S. taxable income. Now, you'd have to file a return to claim the treaty benefits, but that option is available to you. And then the other thing with Canada is Canada Canada is one of the lists, one of the countries on a list of about 40 that has a visa waiver program anyway. So Canadians normally don't have to worry about this. But the point is, if you're coming to the U.S. on a B2, you should just be doing it for tourism purposes and only stay enough days to not trip over the substantial presence test. So this leads us into the closer connection exemption here, IRS Form 8840. What is this? Well, if you're in the U.S. on a B2 or a B1 or a variety of other visas, and you're in the United States arguably too many days during the year, you can meet that substantial presence test, which makes you a U.S. tax resident. In order to walk that back and try to override the day count, you can file an 8840 by claiming you have a closer connection to a different country, right? So if we look at an example here, we have John. He's a citizen and resident of the Cayman Islands. Now, Cayman's not on the visa waiver program. Again, it's only a list of about 40 countries. So he's got to go through the visa application process. He applies for a B-2 as a tourist, so he's traveling to the U.S. now. Well, he's got family in Florida. So in year one, he spends 135 days in Florida visiting his cousins. Well, year one, he's not in the U.S. enough days to meet that substantial presence test, right? Because remember, the substantial presence test is you have to hit 183 days. And the way they calculate that is they take all the days in the first year, or the year that you're doing the analysis, all the days in year one, and then you take a portion of the days from the prior 2 years. So if his first time to the U.S. was this year and he spent 135 days, not a problem. Here's where it becomes a problem. Year two, he goes back, right? And he spends 145 days in Florida again, visiting his cousin. Well, he doesn't meet it for year one because it was only 135, but he is going to trip over the line in year two. And why is that? Because the way you compute the substantial presence test, the 183-day calc, you take all the days in the year you're looking at, so 145 for year two, and then you take a third of the days from the prior year. So he spent 135 days in the prior year, so one third of that is 45. So if you take 145 plus 45, you're at what, 190 days. So now he has tripped over the line, and he's now met the substantial presence test. This is why when we advise clients on coming to the United States, because you bought maybe a retirement home or something, the target dates you want to have is never above 120, right? So if you look at the way the math works, you could basically spend up to 120 days per year every year. And when you take the day count and you do the look back and add up the percentage, the portion of days in prior years, you'll never hit that 183-day mark. You can hit the 183-day mark if you're over 120 and you kind of go back and forth. So that's why we always advise never more than 120 days, which is a lot of time. I mean, it's 4 months. So for our clients that live in Canada or Europe and they want to travel to Florida for the winter, they bought a home in Miami, go for 2 months and then leave and then just come back next year, right? Just keep it well under the 128 days and we don't have to worry about this. So John in this example, he would meet the substantial presence test in year two. So what he would want to do is file that 8840 to claim the closer connection and try to avoid all this nonsense up here that I'm circulating, right? The Form 1040 filings, the F-bars, the 8938s. It can be a disaster to become a U.S. tax resident. So try to avoid it if you can. If you're a U.S. citizen or a green card holder or you want to live in the U.S. full time, well, yeah, that's what we got to deal with. So, okay, so that covers it for this video. I hope that was helpful. If you have any questions, obviously leave me a comment below. I try to get to as many as I can. And I look forward to seeing you again on the next video. Thank you.